What's going on, guys, and welcome back to my channel. Today I'm going to be talking about investing in the healthcare sector. There are a lot of pros and a lot of cons of investing in the sector right now. Today I'm going to address some of those uncertainties and reasons why I'm personally investing in healthcare. So let's just jump right into the video. So this is a glance of XLV, which is the healthcare sector of the S&P 500. And if you notice, basically ever since I want to say September 2018, we haven't actually gone anywhere. And we are exactly at the same level that we were going as far back as January 2018. Now, granted, it is a pretty high spike, so this kind of stat may be a little bit misleading, but there's no doubt that we haven't really gone anywhere since then. And in fact, we've just made a series of lower highs. Yes, we've made a series of higher lows, but we are stuck in this trading range. Similarly, that's kind of the way that healthcare operates, in my opinion, as well as some other sectors. But the last time we were in this trading range was the summer between 2015 to 2016, where we eventually broke out of it, retested this range, and then never really looked back. So one of the great things about kind of going sideways for a lot of companies and just dividend paying companies in general is that the starting yield will tend to increase as time goes on, and that's because companies tend to increase their dividend yields as time goes on. So in a way, investing in healthcare now would give you a higher starting yield than investing into it about 1 year ago. And so at the moment, there's a lot of bargains, in my opinion, that are way more beaten down than the sector view kind of implies. Now, what do I mean by that exactly? So let's go ahead and take a look at some of the holdings of XLV. You'll notice that the largest holding is Johnson & Johnson, and for good reason. I think Johnson & Johnson is one of the strongest stocks around, let alone healthcare stocks, that you can possibly buy into. Extremely diversified company, strong balance sheet, strong history of growth, strong history of increasing their dividend yield. The list goes on and on. You cannot go wrong with Johnson & Johnson. You'll notice, however, that because Johnson & Johnson is 10% of XLV, that the chart looks pretty similar. Again, for Johnson & Johnson, we haven't really gone anywhere since the high here made in 2018, and we've also made a series of lower lows. Now, before I invest in any of these other healthcare stocks, I make sure that on my M1 Finance portfolio, I'm investing as much as I can into Johnson & Johnson because this is an absolute great buying opportunity, in my opinion. We're butting up against some support, some strong support at that here at the 200-week moving average, which has acted as support ever since basically 2011. And so I think this is a great buying opportunity, and I'm not sure how much longer this deal will last. So first things first, let me just say, before I even show the bargains relative to Johnson & Johnson and XLV, let me put it out there that I love Johnson & Johnson, and I'm investing in them right now. The topic of today's video, however, is going to be beyond just Johnson & Johnson. The next thing I want to look at before I actually dive into each of these stocks individually is basically pointing out the positives and negatives of investing in healthcare at the moment. So the positives are that there are an increased need for services, and this goes beyond just healthcare. Basically, when you have companies like ticker symbol LTC, for example, which is long-term care, which actually benefits off of the increasing amount of retirees at the moment, then you have a lot of demand for certain kinds of products. And healthcare companies, despite being very large, are actually quite innovative and are actually pretty good at marketing their products. So there is an increased need for services, not to mention the health issues associated with obesity. And obesity is on the rise. I'm not saying that's a good thing, but someone's going to profit off of these diseases that are becoming more and more common, especially in the not so wealthy places of America and even the rest of the world. And so healthcare continues to be in strong demand. As a result of that, there are strong financials. So balance sheets in the healthcare sector remain flush with cash. And again, I'm just reading off this bullet point. But as a result of strong balance sheets, then that increases the possibility of higher dividend payments, share buybacks, which are actually pretty huge and controversial among the healthcare sector. Mergers and acquisitions. We see mergers and acquisitions all the time. Recently, there's an acquisition with AbbVie. And so a lot of these companies are actually cash cows and they're able to remain strong from the financial perspective. However, there are clearly some negative effects that we have to take into account. And so this article pretty much summed it up perfectly, in my opinion. So the first I'll talk about is the government takeover concerns. So that's basically a situation where the government will actually say, hey, I'm taking the wheel. And what I'm saying is that there's going to be Medicare for all and basically some kind of steering into the universal healthcare kind of direction. And so no surprise, this would be extremely negative for the healthcare sector. And I'm not sure how much a lot of these companies will do after that. So you have to price all of this in before actually investing in the healthcare sector. Now, I don't think that all these companies are going to go bankrupt or something like that. There's a lot of jobs on the line when we're talking about any kind of government takeover, which is basically going to, I don't think it's going to demolish an entire industry, is what I'm trying to say. So, yeah, government takeover is a real concern. The other thing is the regulatory uncertainty. So, if it's not a takeover necessarily, just the fact that there will most likely be more regulations, depending on who takes office and depending on kind of the media and the way that these policies get pushed over the next 10 years, it seems to be like it's not in favor of these healthcare companies. And so that is a definitely an uncertainty. So even if there isn't a takeover, there might still be more regulations. Given all that, I'm factoring that in, and I still think that healthcare is a good sector to invest in, at least for myself. Again, I find so much value here, and this might not be for everyone, so feel free to disagree. Let me know in the comments what you guys think. I'm definitely super curious. But yeah, let's go ahead and jump into some of these stocks. So the first stock I'll talk about, because I already talked about Johnson & Johnson, is United Health Group. So UNH is actually about, I want to say close to 20% off of its all-time high. And so similar to Johnson & Johnson, yeah, that's 19% by the way. So similar to Johnson & Johnson, we did make a higher high here towards the end of December 2018. But you'll notice that this high was actually much higher. And so the correction that we're seeing still puts us at somewhere that's pretty close to the high here made at the beginning of 2018. So all of that is to say that we actually haven't gone anywhere since then. However, in the meantime, United Health has actually increased their dividend yield. So United Health pays a 1.87% dividend yield, but as you guys can see, they're actually growing it at a pretty, not ridiculous rate, but a pretty strong rate. Again, this ties back to these healthcare companies having strong financials. So $1.08 this year, 90 cents the year before, 75 cents the year before, let's see, 63 cents the year before, 50 cents the year. So that's actually really strong growth. And obviously it has to be strong growth because it is paying less than 2%. But the starting yield is a lot higher here than it was here just a few short months ago. So that's exactly what I'm talking about when I talk about starting yields. So next stock on the list that I'll talk about is Merck & Co., which is ticker symbol MRK. You'll notice the difference in MRK, and the way that I'm kind of approaching this healthcare sector is, number one, I'm looking for value. I'm looking for something that's at least 15% off the all-time highs and something that has a bullish setup, in my opinion. Merck & Co. does not meet that criteria, so I'm taking them off the list. Next stock to talk about, Pfizer. I have a pretty sizable position of Pfizer in my main M1 Finance portfolio. Pfizer is a dividend aristocrat. It looked like recently we were breaking below the 200-week moving average, which is a long-term trend, but we actually recaptured it pretty recently. And again, this trend, we never actually strayed too far away from it since basically 2011, so similar to Johnson & Johnson. And so this dip right here was a gift, in my opinion. Off the all-time high, we're actually down about 21%. So that's a good symbol of value, in my opinion. The other thing I want to talk about is the weighted average PE ratio, which is about 22.03. And obviously this doesn't mean all that much if I'm just looking at this one. If we compare that to other ETFs that are basically sectors of the S&P 500, they basically range from anywhere from like 20 to 23 at any given time. So that's not to say that healthcare in general is at a deep discount, but it pays to look at companies that have a below or that have a PE ratio below the industry average, which in this case is 22. So if I quickly go to M1 Finance, we can see that there are clearly some bargains. United Health is one of them. Johnson & Johnson is still a bargain. Pfizer is absolutely one of them, probably the lowest in the top 10. So I love Pfizer for that reason. There are some surprises like Abbott Laboratories. I'm not actually investing in Abbott. The other surprise actually is AbbVie. So the price to earnings ratio is still above average on AbbVie, but the dip is just too good in my opinion. So I continue to buy AbbVie. But yeah, let's go ahead and continue looking at the rest of the stocks here. So like I mentioned, I'm not purchasing Abbott Laboratories. Medtronic, we can take a look at their chart. I'm not purchasing Medtronic at the moment. And all these stocks that I'm talking about, you can find on my value pie. I will link it in the description down below, as well as the rest of my main M1 Finance portfolio so you guys can see exactly what I'm investing in. Next stock on the list is Amgen. So we can go ahead and take a look at that one, ticker symbol AMGN. As you guys can see, this is definitely not a bargain, so we can skip over that one. The next stock on the list I'll talk about is ABBV, which is basically AbbVie. Not basically, that's literally AbbVie. We are finally showing some strength and some kind of indication of a bounce. Now, clearly, we still have a lot of work to get to, but I believe in AbbVie in the long term. And just take a look at how much of a value this is. Dividend yield currently sits at close to 6% or something like that. So we're down 43% off the all-time high. Absolutely, I like AbbVie. The next stock I'll talk about is Gilead Sciences, which is ticker symbol GILD. Taking a look at this one, you'll notice how much of a high flyer it was here towards the bottom of 2010, where this stock increased by a total of 663%, which is absolutely ridiculous. Obviously, we're showing some retracement off of that, and we haven't actually gone anywhere since then. But to put that into perspective, that's still an increase of about 306%, which a lot of stocks can only dream of. And so during this entire time, like I said, that dividend yield actually increases, and that doesn't mean that this dividend yield will continue to increase during a recession. It just means that the starting yield and the margin for error is actually increasing. Now, what do I mean by margin for error? So basically, when you buy stocks at a heavy discount, you're giving yourself a lot more margin of error to be wrong on that stock because what you're pricing in is a lot of uncertainty, especially when we take a look at something like Cardinal Health. Cardinal Health is priced as if it's going to go out of business. So if in fact something bad does happen, number one, chances are the stock price might not take that much of a hit. But number two, it really begs the question, how wrong can you actually be? Meaning, how valuable or how less valuable can the company actually be relative to what you purchased it at? And so I also invested in Cardinal Health in my value pie. Why don't we go ahead and just take a look at the chart right now really quickly. Boom, massive dip. Again, really strong performance since 2009, but we're showing some dip right now. And the other thing I want to point out is I'm not talking about the businesses of each of these companies, and that may be to a fault. I generally have a pretty lax approach to investing in a lot of stocks, actually. I mean, lax to some, maybe not others, but I am a swing trader. Sometimes I day trade, so I approach things somewhat like that. I mean, obviously, I don't invest in just any kind of junk that's showing value. But for the most part, with these dividend paying stocks, I like to see stocks that are beaten down. And so sometimes that plus a few other factors may be the only criteria that I personally use to invest. And so that's not everyone's cup of tea. And I get it. So I'm not forcing my opinion on you. I'm not being extremely persuasive here. If you guys noticed, I'm not banging on the table. But this is just my take on healthcare. And it's not just my take on healthcare, actually, because if we take a look at this mutual fund, which is actually ticker symbol SHRAX, this is the ClearBridge Aggressive Growth Fund. This is actually my favorite mutual fund of all time. And if you take a look at this one, so growth is in the name, not just growth, but aggressive growth. And so that implies that the stocks here have to grow pretty aggressively. So this is basically their holdings, and 50% of their holdings are in just 10 holdings, or 50% of their assets are in just 10 holdings. And what do you notice here? You notice number 2, which represents 7% of this portfolio, is the third largest holding, which is Biogen. And I believe we have a couple others. We have Vertex Pharmaceuticals, and we have Allergan. And so these stocks do have a history of high growth. They may not at the moment, especially because tech and a lot of tech mutual funds have actually led the way in terms of performance, especially over the past 6 years or something like that. I'm not sure how much longer that's going to last. Tech has been skyrocketing for a long time, and while I think that they will continue to lead on most years going forward, that doesn't mean that I think they'll be the clear winner going forward, and that doesn't mean that I don't think that there'll be a close second. And so I do think that healthcare, which once was a great industry, as you guys can see from the charts that I showed, especially with Gilead Sciences, when I brought up how much this stock actually increased from 2009 to 2015, the growth on these stocks can actually be pretty ridiculous. And so that's what I'm taking the bet on. Remember, I'm not purely a dividend income investor. I do invest for capital appreciation as well. And the last stock that I'll talk about today is Bristol Myers, which represents 2.37% of XLV. If we take a look at their chart, once again, we can see that common theme of extreme growth from 2009 all the way to 2016 of about 360%. But since then, we've dipped quite heavily. So that's about, let's see, $76 per share, all the way down to about $50 per share. So that's a decrease of about 34%, which is a pretty steep discount. And so again, I'm not going to go over into each of the individual PE ratios or dividend yields of these companies. I do want to point out though, before I forget, is Bristol Myers' PE ratio is 13.1, and their dividend yield is pretty massive. I know I just said I'm not going to point that out, but yeah, so these are two things I love to see. And then also, before I forget, the dividend yield on Gilead Sciences is 3.83%, and the PE ratio is 14.2. So those are really great features that I like to see. And so yeah, that's my very quick overview of healthcare. It would be a 30-minute video if I jumped into the financials and the type of business models that each of these companies have. So I'll leave it at that. I'll let you guys do the research. Let me know what you guys think. And that's going to wrap it up for this video. So thank you guys for watching, and I'll see you on the next one.